Hello and welcome to the ASB Investment Podcast, a show that keeps you up to date on the markets and helps you make smart choices with your investments. These are entirely our own views and that of our guests. It's not investment advice, but we know plenty of experts at ASB that'll be happy to chat if you need. Joining me today is Ben Powell. Ben is Blackrock's Asia Pacific Chief Investment Strategist, and he's my regular guest when we need to talk about the global financial markets. And between inflation, central banks raising interest rates, share markets slumping, and the conflict in Ukraine, we sure have a lot to talk about today. So welcome back, Ben, and sorry to only call you when I need a hand on a problem.
We're here to help, CTB. Great to be with you, and hopefully we can shed some light and try to be useful for all the listeners here today.
Yeah, exactly. It's a lot of people are worried about the conflict in Ukraine, and that's understandable from all sorts of angles. And we'll get onto that later in the recording. But let's start with what's been keeping us busy this morning, and with fixed interest markets and your thought of the US Fed delivering its first rate hike since 2018. It seemed to me that the hike itself was very well signalled, so no surprises there. But what did you think of the move and also the signals the Fed is providing on the outlook for its policy settings on US interest rates?
Yeah, I thought it was quite interesting. So like you, I thought the hike itself was fine, right? But I think, as you say, very well telegraphed, very well signalled. For us, the more interesting bit, for me, the more interesting bit was the how many they're going to do overall, right? Where they're going to end up at the end of the hiking cycle, which I guess we call the terminal rates, right? So how high are they going to get to? So the Fed has now fairly radically transformed their view of how high they want to go through the cycle up to something like 3%. So from, close to zero and lots of quantitative easing to QT, quantitative tightening, and, moving up to 3% over the next couple of years is pretty meaningful. So that has any number of implications for the portfolio that we can get into, CTB. And also, we also question if they can get there, given the likely downdraft that will cause for the economy, of course, but more importantly for employment and the social kind of downside of accidentally over-tightening, I guess, or deliberately over-tightening maybe. Maybe it helps with inflation, but it does have a trade-off in the world of employment. So for us, we don't think they'll get to 3. We think they are too ambitious, as it were. We think maybe 2.25 is where they'll end up. But I think that's kind of the key conversation. I don't know what you think, CTB, but the 25 basis point hike is, of course, important and interesting, but it's the how many are they going to do overall that I think is maybe the crux of the matter. At least that's how we're thinking about it.
Yeah, I'm on the same page. I think when we talked about central banks over the past 6 months, we've thought economies are recovering and it's time to start removing some of the stimulus that's being provided around the world. And that leads on to a conversation about, well, where do you think neutral rates are going to be for the economy and what sort of level of increases do you expect? And the conversation was generally along the lines of central banks will want to keep giving growth a chance, but just start to slowly remove some of the stimulus. But whereas now it feels like, apart from, say, the Reserve Bank of Australia, banks are really looking at tightening the economy and slowing growth to reduce some of this inflation pressure. The Fed's growth forecasts were lower within today's detail as well. And that same sort of chat's happening here in New Zealand. We've lifted our expectations of where we think the Reserve Bank will lift the cash rate, for example. So that leads it and perhaps points to what you might think with my next question is, what are your thoughts on the current pricing of longer-term fixed interest investments? 10-year government bonds are a good place to start as a reflection of very long-term views on where interest rates are going to be in the economy. And a number of investors are asking how long the pain will continue in their bond portfolios because they're obviously sensitive to it. So how do you feel like if we did a trip around the big central banks, thinking of the Fed, the Bank of England, Germany, how do you think 10-year bonds are trading these days in terms of a reflection on those central bank outlooks?
I think the pain's going to continue, simply put. So just to enumerate the pain, I mean, I think this is an amazing stat, so get ready. The US 30-year Treasury, in round numbers, is down its price, right? Price, because that's important for an asset you own in the portfolio. The price of the US 30-year Treasury is down a little bit more than 30% over the last couple of years, which is remarkable. And so we can all agree that the US Treasury is likely to repay you, and therefore it is a risk-free asset, right? You're going to get repaid principal and coupon. So it is risk-free. But from a price perspective, that's some pretty hairy volatility, which can't be ignored, we would suggest. So given we think inflation is going to hang around a bit, for reasons we can get into if you're interested, and given the broad direction of yields is going to be, we think, higher over time, maybe, we're talking about the 10-year, you asked me a specific question. So I don't think the US 10-year yield is going to move dramatically higher from here, more of a grind, but still, for choice, the yield is higher, which is to say price is going to go lower. So I think in terms of when you look at, your monthly statement and you look at the price of developed market government bonds, clearly they can still play an important part of the portfolio. But for us, developed market government bonds are just swimming against the tide, right? We're in a hiking regime, I guess, moving forward, driven by this higher inflation, which is going to persist. And it's kind of nobody's fault. It's just a fact, and it's inconvenient for DM Gov bonds. So for us, within the bond bit, I guess, of the portfolio, we're all going to have to be, and this is hard, I fully understand this, but we're all going to have to be a little bit more kind of creative, I suppose, in where we source income. Maybe we have to look further afield by geography, by asset class, or whatever, where we source income, and also where we source kind of ballast within the portfolio, having that kind of safe haven thing. Because as I mentioned, and by the way, picking the 30-year Treasury is, I've done it on purpose because that's the most volatile, right? So if you come closer in, the price moves are less dramatic. We should be clear about that. I should be clear about that. But nonetheless, I do think there is downside price risk for developed market government bonds, which is going to persist. And that's, as I say, something we think needs to be taken seriously and therefore adjusted in the portfolio accordingly, which is an overly long way, CTB, of saying we still think, as I've said on this podcast before, we should all be owning fewer developed market government bonds than would have been historically normal, because there is, we think still, even after the fairly dramatic price falls that we've seen, we still think there's price downside to come from here, because yields are going to drift, we don't think very fast, but going to grind, I guess, a little bit higher in the months, quarters, and even years ahead.
Yeah, that's very consistent with the conversation we had back in late last year when we were talking about the outlook for the year ahead. And I think the hard thing for investors to get their heads around, and we spend a lot of time explaining it, is that these big movements in the price of bonds are not because of credit events. Like you say, if you can't count on getting your money back from a US 30-year Treasury, there's not much you can count on in this investment world. But nonetheless, a 30% price move is normally what we'd associate with a bond that was in dire straits for some company that was quite a worry. But these are interest rate adjustments. So it's one of those things that I think advisors and people like me will continue to be busy with over the year ahead to understand what's driving these. But hey, you touched on inflation, and I think that's the other part of this picture, is that people are worried about the outlook for growth, and that's understandable when they see things like COVID and Ukraine. But central banks are clearly more worried about the outlook for inflation, and we're seeing some pretty nasty numbers coming out. Oil isn't helping right now, but beyond that spike, the view that this is transitory that we talked about probably 6 months ago doesn't seem to resonate with many now. What are your latest thoughts on inflation for the year ahead? And I'll start with New Zealand. We're thinking that it's going to peak at over 7% over the next quarter or so. So what are your thoughts about inflation around the world and how long the spike we're seeing may last?
So I think although the current very, very high levels of inflation, of course, linked to the situation in Ukraine and so forth, That's unlikely to persist. So we should probably see inflation drift down over the next 6 to 12 months, but it's probably going to settle at a level somewhat higher than we've been used to over the last 10 or 20 years or so. And that's being driven by a few factors, including Chinese labor force is going negative, right? So there's been hundreds of millions of workers added to the labor force over the last few decades. That's going into reverse. The energy transition is going to cost some money, so that's probably somewhat inflationary. And then more broadly, I think we are seeing something of a localization of supply chains as they want to become more resilient. And the flip side of that is less efficient, which again should speak to a kind of persistent inflationary impulse. So when I throw that all in the mix, we end up with inflation, to come to your direct question, it's not going to persist. It's almost mathematically impossible is a strong word, but it's very hard for inflation to persist at the current super high levels for a long time, clearly for some time, and that's very uncomfortable, but should drift down, but settle at a level which is higher than we've been used to for the reasons that I've mentioned. Key to inflation coming down over the next several quarters, global inflation, I guess I'm talking about here, is actually more and more economies, countries being able to open up as COVID becomes less restrictive, at least in an economic sense. And that should allow supply chains to normalize, more goods to flow more easily all over the world. And that should be a fairly significant, actually, disinflationary driver, helping alleviate the really high levels right now to come down somewhat. But again, just to stress this because it's important, inflation, we think at Blackrock, is going to settle at a level which is, as I say, probably higher than we've got used to over the last 10 or 20 years. And that has very meaningful implications, frankly, for everything, whether you're a central banker setting policy, whether you're a consumer at the shops buying your weekly basket, or as investors, when we're thinking about the portfolio. All of us are going to need to be quite thoughtful about how we are resilient to inflation, because, as I say, even though it's going to come down somewhat, it's not going to disappear. And in fact, it's going to settle at a level a bit higher for the reasons I've mentioned than we've probably got used to over the last decade or two.
Yeah, I think that's a remarkable transition from inflation being too low to suddenly looking way more like the inflation we worried about, certainly in the period of time that I was studying in the early years of my career. And I think at the risk of jumping to a conclusion, a comment you made there about this as being the first time that some people have seen it is interesting. Another thing, we get a question asked a lot: why don't I just sit on the sidelines and do nothing for a couple of years? Inflation at the moment is just highlighting the huge opportunity cost of doing that, because if you sat on the sidelines now, well, you will have less purchasing power in 6 months with the rate that these prices are going up, without a doubt. And so to a certain extent, the inflation environment that we're talking about leads into people just needing to think really hard about their long-term goals and be prepared to put up with some volatility in order to get there, because cash is just not getting there. And it's even worse now with these higher inflation rates. Whereas a few years ago, even though our term deposit rates were at record lows, the actual after-tax, after-inflation return that folk were getting was actually really high. But those days are over, firstly because rates continued to get lower until recently, and now as quick as rates have started rising on those conservative investments like term deposits, inflation's just galloped ahead of them. So now, for example, you can get a 5-year term deposit at around 3% here in New Zealand. But with an inflation forecast of twice that for the next 12 months, it's not a great deal. So the bottom line here and overseas, I think that we agree on, is that central banks will be worried about that more than anything else. And the question that we've touched on is just how high do they go to try and get inflation back into check. And we're thinking the Reserve Bank's still got a lot of work to do, and likewise the Fed clearly signalled that. today. Hey, but let's move on from inflation to something a little bit more positive, hopefully, certainly at a personal level, and that's COVID and economies reopening. It's definitely happening here in New Zealand. And on a personal note, as I've told you off this podcast, my brother arrives home from Australia today and I'm collecting them from the airport in a couple of hours. That'll be the first time I've seen him in a couple of years. I hope you've got similar plans to be able to see a few more people and friends and family. I know you missed out on your Christmas that you're planning. What are you seeing and expecting up in your part of the world in Asia?
So Asia is a mixed bag, right? So I think just on the broad point, reopening is kind of the mood music. Very interesting to see the Fed actually removed any mention of COVID from their kind of formal remarks. Of course, Ukraine, I guess, is the more pressing subject, but just quite interesting to see the Fed just move forward from COVID after the last 2 years. It's something like over, it seems, at least in the Fed's mind. Reopening globally, by the way, is kind of very good, of course, for economic activity, but also, not to go back to inflation, but should mean some of the supply bottlenecks actually become less problematic. So actually, weirdly, this growth positive opening, which when people think about growth positive, they tend to think, oh, that must be inflationary. Not so fast, right? We actually think this reopening should help the supply side, allowing more goods to flow a bit more efficiently, and actually should help the current, as we were just talking about, very high spike that we're seeing come down a little bit over the remainder of the year. In Asia, you asked me specifically about Asia, a game of two halves, I guess, with China playing a different game. So I'll just talk quickly about China and their different approach. They are still going for something like zero COVID. It's not exactly as we would understand zero COVID in the West and how we approached it, I guess. Dynamic zero is a phrase that they use, which is a little bit confusing, but it's going to continue, I think, with targeted, localized, China would argue, very kind of efficient, specific village by village, even building by building, can you believe, lockdowns. But that's going to kind of continue to be the mood music in China, including Hong Kong. So that's significant because that's the world's second largest economy and so forth. So I think that's worth touching on. More broadly in Asia, you guys are seeing in Australia, here in Singapore, little by little, we are seeing a normalization of life, which is great. We're going to be getting back to England, me and my family and my guys, for the first time in 3 years. And given my kids are 4, 2 5s, and a 6, it's sort of their first trip in a way, right? First trip that hopefully some of them will remember for forever. So we're pumped, as you would expect, around that. It will be a nightmare, let's be clear. We travel very heavy, but it should, when we get there, be awesome. And hopefully that's a story that resonates with loads of people listening here. Hopefully we've all got something that we're penciling in, or even penning in, right, we're committing to, which can be that old thing called fun, right? Remember that? So hopefully more of that season would be fine.
Absolutely. Fun and family is something that I think a lot of people have been short on. So that's excellent to hear that you've got some plans there. And yeah, that mixed view in China in particular is interesting because the reopening, I agree. In New Zealand's case, one of the obvious things is just the acute labour shortages in some areas that have often been plugged by people coming from overseas to work in New Zealand for a short term or a long term. Maybe people like you pursuing a rugby dream, but also being part of the labour supply at various jobs. But what about the Chinese restrictions? Is that just going to clog things up on the supply chains from there for a while longer? Or how do you see China specifically and their lockdowns impacting some of the restrictions of trade that we've been seeing?
I'm not sure my 8 months with Auckland University under-19s moved the markets that much, CTV, but it was a good time. So yeah, look, it's important. China, if anything, has become more central to the world's supply chains over the last couple of years. So you know, going back to Trump and America First and all of that stuff, so far, China has, again, become, if anything, more important, right? It's become more central to global supply chains. So clearly, China being locked down and potentially I mean, let's see. Omicron, of course, is very transmissible. Vaccination status in China is unclear. So, of course, I think this is a critical unknown, right? To be honest, you've got to give China some credit. They have done an astonishing job with the effective, efficient lockdown so far, using methods which maybe would be harder to bring about in Western countries. So there's that on one side of the ledger. On the other side of the ledger, Omicron is infamously, unbelievably infectious, and therefore you could see it infecting people, right? So I think this is like a key downside risk for the world, frankly, obviously for China directly. But this is really worth watching because it's happening kind of right now, right? We've had Omicron cases really pick up to the low thousands in China, which is a very high, very, very high number by China standards. So clearly, what we know about Omicron is that could become wildfire, right, very fast, or China can continue to surprise us with how good a job they do at restricting it. So that I think we'll see one way or the other over the next couple of weeks, and frankly, seems to be either way. If they get control of it or don't, is very important for not just for China, but for supply chains and for risk more broadly.
So that's definitely one thing that we'll be keeping an eye on. And let's turn to Europe and the Ukraine developments. And you and I are both economists rather than military strategists, and I certainly don't claim to have any expertise on the Russian securities market. But I do know that from my career that goes back into the 90s, things that go on in Russia can end up flowing around all the way to this part of the world. In my case, back then, I was working at Bankers Trust happily as a graduate, and I thought that was the best thing since sliced bread, but I didn't know that the Russian debt crisis was going to be the beginning of a bunch of changes for that company due to their exposure. So even though Russia's such a tiny part of trade for New Zealand, we've always got to worry about contagion and how these things can flow on. What's your take on how serious the sanctions are, the implications of a Russian debt default, if that's what's going to happen, and some broader themes that you're thinking about in your role?
I think it's pretty serious. I mean, this is unprecedented in modern financial history that a central bank's reserves can be disappeared, right? This is new. And very interesting and important. I would suspect there will be some quite agitated conversations at very high levels in many countries all over the world, assessing what do we think about that, guys? Because I think it's non-trivial. So implications, it seems to me, are a potential more impetus for trying to develop more resilience around financial independence, right? So moving away from dollar-based payment systems, SWIFT and all of that, which is hard, by the way. That's not easy to do, but I would think the impetus is only greater. So the broad point I would make is I think we're seeing across so many different dimensions, energy, labor force, migration, and maybe even, sounds prosaic, but it's very important, like financial payment systems and how markets actually work, is a localization. Right? We're seeing things come home, be onshored, including maybe payment systems and even capital markets. So, China has got some shares listed in America, so-called ADRs. They have been under a lot of pressure because there's a sense that the American regulator maybe is not comfortable with having these Chinese shares listed in America. So maybe they need to go home, right? Let's see. That there's a lot of uncertainty there. But the broad thought, I think, is Russia and the sanctions is another I suppose, example of the globalized system not being as resilient as we might have thought just a year or two ago. Right? And things we thought to be obviously true are not true. So that's significant. And as I say, I think it's, whether you're the German chancellor thinking about dependence on Russian hydrocarbons or the head of a financial system of a major country, maybe not on great terms with America, how comfortable you being dependent on SWIFT is totally different, but the same kind of thought in terms of moving towards a more resilient, and the ultimate, I think, of resilience is doing it yourself, right? So for me, one of the big things is going to be deliberately having less efficient but more resilient supply chains, financial systems, and so forth. So it sounds weird that you would choose less efficiency, But if it means you can rely on it, you can guarantee it'll be there tomorrow, maybe that's a trade-off that more and more countries are going to be not just willing to make, but actually anxious to make, because the downside of being vulnerable looks like it's pretty acute, as certain countries have found out over the last couple of weeks.
Yeah, I think it's probably no comfort for investors, but the reality is this is not the first time that people like you and me have had to sit around wondering about what some of the second and third round effects are going to be of some of these events, and there's a lot of moving parts at the moment. And right now, the impact on most people seeing here beyond the human tragedy, of course, is extremely high fuel prices, which is a big tax on a energy importer such as New Zealanders, and investors are seeing it via the weakness in share markets. And it just seems that this is going to be something we have to put up with and just watch over the coming months. But as I was saying, it's not the first time, and in fact it seems to be one of those things that comes along every year or two, that the world gets very complicated, and we have these amazing interactions between financial markets, trade, and investments. So what are you going to be watching over the coming months, and building on that, what do you think investors should be focusing on over the coming months?
Well, so what I'm focused on, many things, obviously, CTB, as you well understand, but I'll pick one. It's COVID reopening, meaning supply side can normalize. So that's a highfalutin way of saying factories open, port congestion gets a bit eased, and that should see inflation come down, actually. So not right now, but that should be the mood music over the next 6-12 months, let's say. Supply getting easier, meaning inflation can come down. Meaning, as I started with, maybe the Fed doesn't need to do as many hikes as they currently think they need to do. So I think that's kind of a huge deal. I know it sounds like really boring economics stuff, supply side, blah, blah, but I think it is really, when you work it through, I think it's kind of important. So in terms of what we should be doing about it, again, inflation probably won't persist at the very high levels, but is likely to hang around for some years to come. And that means when you think about the portfolio, being not invested is very risky. Again, like I don't want to lecture anyone here, but I think it would be a mistake to think of being on the sidelines as being safe. Fair enough, you might miss the vagaries of the market over a week or two, but if inflation is going to be some percent, then if you're on the sidelines in cash, you are guaranteed to lose purchasing power over the next 1, 2, 3, 5 years. Maybe that's okay with you, but you should just frame it appropriately and understand that. So for us, real assets and the importance of making the portfolio resilient in general, obviously, but specific to higher inflation than we've been used to over the last couple of decades, that is central to how we're thinking about portfolio construction.
Yeah, I think there's some really good points for investors there. And the one that I really like that you've made is that the COVID reopening, which is positive for growth, is actually also positive for helping with these inflation pressures. That's a really important theme. You know, China's a big unknown, but as you've mentioned, they have been successful in their strategies that perhaps wouldn't even be able to be rolled out in other parts of the world for all sorts of reasons. And Ukraine is just one of those events that we just have to watch and see unfold. But I think there's some real things for investors to focus on. And, you know, as a parting comment about our view that we often come back to about not trying to time the markets, you know, the Fed got underway. There's no doubt that they're raising rates when they actually deliver the first hike and then say we're going to do plenty more. But the interesting thing, I think, for investors is share markets actually had a fantastic day today. Now up 2 to 4% in the States. So that's why we don't get too cute to try and be on the sidelines and think that we can pick the good days and the bad days. And we certainly got a good lesson in that 2 years ago as well. So hopefully our investors have found this useful to listen to. I've certainly got heaps of interesting insights from talking with you today, and I'll look forward to checking in for the next one soon. And maybe these borders reopening mean we can get into the booth in Ponsonby and actually record something face to face. Would be a quite nice goal for the year ahead.
Go ponies. Yeah, no. Look forward to CCP all in good time. And hopefully that's right. Hopefully we're coming back to a fund-centric world. That would be great.
Thanks for listening to the ASB Investment Podcast. If you have any thoughts on today's episode, or if there's anything you'd like us to discuss on a future show, get in touch at podcasts@asb.co.nz. Blackrock Investment Management Australia Limited is a wholly owned subsidiary of Blackrock Incorporated. Blackrock Incorporated is based in the United States and is a leading global provider of investment management services with over US 10 trillion in assets under management as at the 31st of December 2021.